Hi, today we're going to talk about derivatives fundamental concepts and concept of arbitrage. So in derivatives there are two things. One is derivative price and another is derivative value. So there is subtle difference between these two, and we need to understand how to differentiate between them. So price refers to a market price of a stock or derivatives or any other assets, whereas the value uh, is based on the intrinsic value of assets. It is determined by computing the present value of all future expected output by adjusting with the present value of any future benefits and present value of any cost. So let's suppose we have an asset which has a future price or forward price. We can discount it back uh, using a risk-free rate of return plus any premium. It depends on investors. If the investors is risk averse, then he may need a premium, and an investor is risk taker, then he may just need a risk-free rate to derive the present value of an asset. If asset produce any benefit, then we need to calculate the present value of those benefits as well. So benefits could be like in terms of dividend, or we may return in interest. So these are example of monetary benefits. There are non-monetary benefits also called uh, convenience yield. So those benefits should also be quantified, and we should calculate the present value. There's also some cost associated holding the asset. For example, there may be some maintenance cost or storage cost of an asset or commodity. So those costs should be deducted to derive the value, and we should get the present value of those costs. So by doing this, we can calculate the value of an asset at time zero. That's what we're talking about. And later we see if we need to calculate the value of asset somewhere in the middle of the contract, or value of asset at the expiration. We're gonna explain those scenarios in later sections. But this is a quite intuitive formula. We're just deriving the present value from the future value and subtracting any present value of cost and adding any present value of benefit. It helps us to derive the value of a derivative. The second concept is arbitrage concept, so which we already aware of. So uh, arbitrage, the way it works is um, the left hand side of equation should always equal to the right hand side of equation. So derivatives can be used along with the portfolio of risky assets to produce the risk-free rate of return, so that the overall risk can be minimized. So assets plus derivative equal to risk-free rate of return. We have it in the equation. There are three examples of arbitrage, which is no arbitrage price examples. So in these three equations, we assume the left hand side is must always equal to right hand side. So the first example is if we buy a stock and we short the future contract. So it means in future we have to delivery or settle in cash that future contract. And at the time of expiration, since we have a stock, and we also short the future contract, we must receive the settlement price in the end. So this equation should result into the present value of the settlement price. So this is a kind of arbitrage example. If this equation doesn't hold, then we can we can make profits out of this equation by rearranging the equation, or by selling the stock, buying the stock. So we can we can make profit because there is arbitrage exist. The second example, if the risky bond and we buy a credit protection, like we talked about CDSs in past. So if we buy CDS on risky bond, then the risky bond value should be the same as a risk-free bond value, because we remove the credit risk from the bond. So which is kind of makes sense. If this equality doesn't hold, then there is a arbitrage situation. The third example, if we have a stock and we buy a put option to cover any downward movement of the stock, and we sell a call option to giving up any benefit of stock price going up. So we can kind of create arbitrage price at exercise price, because we lost the upside potential by selling the call option, and we kind of covered ourselves from downside downside any downside by buying the put option. So it must always pay the exercise price, and the present value of exercise price, it must always equal to. So if any situation this equality doesn't hold, we can make profit out of it. Thank you.